Chapter 19, Share-Based Compensation. This is Part 3, and we're going to cover earnings per share. Now, earnings per share, a way of summarizing the performance of a business enterprise in a single number. The comparability of earnings per share number is maximized by minimizing the inconsistencies in their calculation from one company to the next. Now, normally, basic earnings per share is earnings available to common shareholders divided by the weighted average number of common shares outstanding. Calculation of earnings per share becomes more demanding when the number of shares has changed during the reporting period, the earnings available to common shareholders are diminished by dividends to preferred shareholders, and we attempt to take into account the impending effect of potential common shares, which means if you have stock options or you have preferred convertible, these all would affect earnings per share. Now, basic earnings per share. We have Mike Company. They have $100,000 authorized, $1 par, and here's what they've done. They issued 35 million shares, and then they entered into an agreement to issue 2 million shares of common stock to the president based on the company's earnings, and then the company issued another 4 million shares, and their net income for the year is $148 million. So what does that look like? Now, we don't have to worry about preferred stock because we don't have any. So first, we're going to figure out basic earnings per share. It's always net income minus preferred dividends divided by the weighted average common shares. Determine the weighted average. You take into consideration when issued except for stock dividends and splits. Remember, we always assume that they take place at the beginning of the year. Now, this part we're going to ignore for right now because when we do basic earnings per share, we don't worry about conversion issues of other things into common shareholders. So, on January, beginning of the year, we had 35 million shares for the whole year, and then we issued another 4 million. So that was for 9/12 of the year. So we have a weighted average of 38 million shares, and our earnings per share is going to be, since we don't have any preferred stock with dividends, 148 million divided by 38 million shares gives us earnings per share of $3.89. Reacquired shares. The weighted average number of shares is reduced if shares are reacquired during the period, reacquired either as retired shares or as treasury stock. The number of reacquired shares is time-weighted for the fraction of the year they are not outstanding, prior to being subtracted from the number of shares outstanding during the period. When a stock distribution dividend occurs during the reporting period, any sales or purchases of shares that occur before but not after the distribution are increased by that percentage. So, when a senior class of shareholders, like preferred shareholders, is entitled to a specified allocation of earnings, these amounts are subtracted from earnings before calculating earnings per share. We subtract dividends on cumulative preferred stock even if not declared this period, the presumption being that the dividends eventually will be paid. So if they have dividends in arrears of 3 years, then you would have to subtract out 3 years' worth of dividends on the preferred stock. So here's our example. Mike has 200 million shares of common stock and 3 million shares of 9% par cumulative preferred stock issued and outstanding. On March 2021, we repurchased 24 million shares of common stock. On July 1st, we had a 5% stock dividend, and on October 1st, we sold 4 million of the treasury stock. Net income for the year is $150 million. What is earnings per share? So, determine the weighted average. Rule: for a stock dividend or stock split, you treat it as if it happened on January 1st. Any transaction before the stock dividend is adjusted for the stock dividend. Any transaction after are not, because we're assuming they're reflected. So, we're going to take our beginning balance times the 1.05, which was our stock dividend, plus our treasury stock adjusted for the stock dividend and for the number of months outstanding. Again, these are both subject to the 5% adjustment because they're before the stock dividend. And then we have our treasury stock that was sold. We don't adjust that because it happened after. This is our weighted average shares of common stock. And then we're going to take net income minus the preferred dividend divided by 190 million shares, and that should be shares. Let me fix that. So that's 190 million shares. Gives you 65 cents for earnings per share. Now, diluted earnings per share. Potential common shares, securities that are not common stock but might become common stock through their exercise or conversion. This is called a complex capital structure, when any potential common shares are outstanding. Examples of potential common shares would be convertible bonds, convertible preferred stock, and stock options, and contingency issuable securities. Now, diluted earnings per share when complex capital structure. A firm with a complex capital structure reports two earnings per shares. Basic, you ignore the dilutive effect, and diluted earnings per share incorporates the dilutive effect of all potential common shares, excluding anti-diluted conversion or those that would cause earnings per share to increase. So diluted earnings per share can never be higher than basic earnings per share. That's really what that's saying. Now, here is our example. Mike had a net income of $520 million. The tax rate's 25%, and they paid $2 per share on the preferred stock. Okay, they had common shares, they had convertible, preferred, and convertible bonds. So, basic earnings per share would be by $520 million minus the dividends on the preferred divided by 100,000 shares, and that gives you $4 for earnings per share. Diluted earnings per share. Total shares are 100,000 plus the 32,000 from the preferred stock and the 500,000 from the convertible bonds. Says that our shares of common stock, if everybody exercised all their rights, is now 145,500,000. Now, the thing to remember though is that if you are converting, then you have to add back in the interest and not back out the dividends. So, adjust income would be 500,000, and then you have to add back in the interest adjusted for tax. So, our adjusted net income is $574 million. So, diluted earnings per share is going to be $574 million divided by our 145,500,000 shares, which gives you $395, which is less than earnings per share, so it would appear on the income statement. Now, what if instead the bonds had been 10%? We would have had a higher earnings per share, which is anti-dilutive, so all that would show would be earnings per share. Now let's look at a second example. Now in this example, we got all kinds of things going on. All right. So first, we had 600 shares of common stock and 300,000 of 8% non-cumulative, non-convertible preferred issued and outstanding. In 2021, Mike Corporation had the following transactions. They sold 60,000 shares. They issued a 4% stock dividend. Then they retired 2,000 shares, and then they paid cash dividends of $400,000 and $75,000 on the preferred stock. In addition, they have an agreement with the division that if the division's net income is at least $500,000, they will issue an additional 23,000 shares, already adjusted for stock dividend. On December 31st of 2022, the division for 2021 had net income of $630,000, which means they've exceeded their goal. They also have a stock incentive program for the current and previous years. Each permits the holder to exercise 1 year after the grant date for a share one share of common stock at the market value on the grant date as followed, adjusted for stock dividend. So we have them at various prices, and then on July 12th of 2019, Mike issued $800,000 of 10% convertible bonds at face. Each 1,000 bond can be converted to 30 shares of common stock. Now, what does all that mean? So let's first look at earnings per share. So, again, we have to assume that stock splits at the beginning of the year. So we're going to look at our beginning balance times the stock dividend. We issued another $60,000 for 10/12 of the year. And then we retired. But it happened, this transaction was after the stock's dividend, so we ignore the stock dividend. And now we have our weighted average for common stock. And we take out the preferred dividend, and we get $3 per share. Now, what does it look like for diluted earnings per share? Well, we got the same information. So let's work it through. So we'll go through this. First, at weighted average, we're going to take our beginning balance. That hasn't changed from before. Now, our retired, this pretty much stayed the same, but now since we exceeded our revenue goal, we have to assume these were issued at the beginning of the year, so that would be 23,000 shares right there. Now, the next one is a little confusing, but I tried to walk you through it. Now, it is assumed that if the purchase price is lower than the option price, it will be exercised. So if we look at these three, the 3,000 options and the $6,500 options are not going to be exercised because the price is equal to or greater than what they can buy it on the open market. But the 8,000 options at 24 would be exercised. So here's what we have to do. The common shares are purchased as treasury stock at average market price. So the average market price, as we know at this point, is $32. So what we're going to do is we're going to take our 8,000 shares times the $24 option price equals 192,000 shares, and now $192,000, I'm sorry, and we're going to divide by our average, which is $32, which means we're going to have 6,000. That's what we're going to have to buy in treasury stock. So 8,000 minus the 6,000 means that we're really only going to add an additional 2,000 shares for the whole year. So again, these two are ignored because the exercise is equal to or greater than the $32. Now the convertible bonds, we have to throw those in there and assume that's from the beginning of the year. And the way we come up with that is we take 800,000 divided by 1,000, because bonds are usually in $1,000 increments, times $30 per bond. You get 30 shares per bond, gives you 24,000 shares, and we assume that the conversion is at the beginning of the year. So that's our weighted average. And that would be $286, which is less than the $3. So we would show that also. So you can take a look at that for a minute. Now the reason we subtract out our, over here, our dividends on our preferred stock because they weren't converted. Now the last thing we're going to cover is stock appreciation rights. Now,
These enable an employee to benefit by the amount that the market price of the company's stock rises without having to buy shares. Employees are rewarded the share appreciation. So, the amount by which the market price on the exercise date exceeds a pre-specified price, usually the market price at the date of the grant, usually payable in cash, or the recipient has the choice between cash and shares. Example, if the share price rises from $35 to $50, the employee is going to receive the difference of $15. Now the question, are SARs debt or equity? The accounting treatment depends on whether the award is considered an equity instrument or a liability. If the employee can elect to settle in shares of stock rather than the cash, the award is considered equity. If the employer will receive cash or can elect to receive cash, the award is considered to be a liability. And that concludes this presentation.